Hi, my name is Caleb Mugendi. I'm a Senior Associate Equities at Nabo Capital. Today we'll be discussing about the investment outlook in the equities market for the year 2022. Looking at the market in 2021, we did have a run-up in prices, especially in the financial services sector. A number of banks did well, and also in Safaricom being the major listed company at the bourse. What was driving these increases in prices? We had a number of things last year, as we saw a kind of recovery from the COVID-19 pandemic that hit the country in 2020. And this theme will also continue to play out in the year 2022. Looking at the corporate earnings, we do expect record earnings, especially in the financial services sector, the banking sector, for instance. Registered profits in excess of pre-COVID pandemic levels by the month of October last year, higher than the pre-pandemic levels. So we expect record earnings in the banking sector. And we do also expect that banks will continue to announce measures to continue with this profit growth and earnings growth in the year 2022, and also announce a lot of dividend payments to their shareholders, given that they cut back in 2021. So we are quite bullish on the banking sector, on the financial services sector, given corporate earnings growth expectations for last year and also for this year. We don't expect this earnings growth to continue at the same pace. We do expect last year to have been, given that it was coming from a lower base, we do expect it to be much higher than what we expect this year. A number of other factors do affect the equities market. We have external factors, we also have internal factors. External factors being investor sentiment. Our market is primarily driven by foreign investors. And foreign investors react to a number of things that occur globally. We have geopolitical tensions, we have monetary policy tightening, especially expected in the United States by the Federal Reserve this year. We have geopolitical tensions that we're seeing in terms of Russia and Ukraine. And we also have a number of factors that can easily sway investor sentiment externally, also being that 2022 is an election year in the country. So those are some of the external factors that investors will have to look out for this year. Some of the fundamental factors, though, remain strong. The market is currently trading below its historical average in terms of the price to earnings level at around 11.8, 11.7 times versus a historical average of close to 12.9. So we do have some uplift expected there if we can re-rate back to historical averages. And also expectations of earnings growth this year. We expect corporate earnings growth to continue robustly. We don't expect a lot of lockdowns that we saw owing to the COVID-19 pandemic that we saw in 2020 and 2021, despite the emergence of the Omicron variant. That has not led to further lockdowns in the country, so we do expect economic growth to remain supported by that. Economic growth is also one of the things that investors look at, especially for companies or sectors that are more aligned to the economy. If the economy does well, some of these sectors will do well, and that's why I can circle back to the banking sector. With robust expectations for economic growth back to historical average of around 5%. We do expect then that the banking sector will do well. As you know, they'll be able to supply credit to businesses and enterprises that are operating within the economy, and are expected to continue to do well this year. So looking at those factors, we can also look at another fundamental factor being we looked at valuation, corporate earnings growth. We also have to look at the elections that are going to happen in the country this year. That has been weighing on a number of investors who had expectations of possibly had decisions to make of whether to remain invested or to exit the market. Looking at the previous election cycles in Kenya, if you look at 2017, 2012, we've had a peaceful run of election, and also the market has responded quite well. If you just look at then 2007, 2008, then we had that outlier event. So we don't expect a lot of insecurity in the country. We do expect that the change of government will be peaceful. So with that, the market should still respond well to the fundamental drivers of the country, of the economy, of the market. That is, fundamentals remain. We have a lot of undervalued sectors. We have a lot of pocket of values here and there, and we do expect investors to come in and take advantage of these undervalued sectors as we progress during the year. So looking at equities, it is a long-term investment strategy that you have to employ. There will be a lot of gyrations in the short term, in the short to medium term. And this is now for savvy investors to try and take positions when there's a lot of fear in the market. Usually that leads to depressed prices. And looking at the fundamentals of the company, the sectors, the different sectors, and of the country and the economy. Something else that will drive the market this year, we have security that I've mentioned, being expectations that we'll have an election that will be quite peaceful, so the changing government will not affect the market as much.